Something strange is happening in the silver market right now. And if you only looked at the price chart, you'd be missing the most important story underneath it. Because here's the thing, when silver drops brutally and fast, most people ask the wrong question. They ask, why is silver falling? But the right question, the one that separates the investors who come out ahead from the ones who panic sell at the worst possible moment, is asterisk who is selling it and what are they actually selling? That distinction is everything. And once I walk you through what's really happening inside this market right now, I think you're going to look at this drop in a fundamentally different way. So let's get into it. Let's pull back the curtain on the machinery behind these silver crashes. Because the shocking real reason behind this one isn't what the financial media is telling you. It never is. Now, before I go any further, if you're someone who wants to understand how to actually protect their wealth through all of this, I put together a free guide that lays out the saving secrets that thousands of American retirees are already using. It's in the description below. Check it out at your own pace. For now, let's dig into what's really going on. The first thing you need to understand is that when silver drops dramatically, and I mean a sharp, violent, gut-wrenching drop, your first instinct is probably to assume something fundamental broke, that the demand for silver collapsed, that the industrial story fell apart, that the monetary argument got debunked somehow. But that is almost never what actually happened, and it's definitely not what happened this time. What actually triggered this crash was something far more technical, far more mechanical, and in many ways far more revealing. It started in the futures market, not in a silver mine in Mexico, not in a solar panel factory in China, not in the vaults of a central bank in Eastern Europe. It started with a decision made by a group of financial administrators to change the cost of playing a particular paper game. Let me explain what I mean by that, because this is the heart of everything. The silver market has two versions of itself. There's the physical market, where real, tangible silver bars and coins change hands. And then there's the paper market, a world of futures contracts, options, and derivatives, where traders buy and sell promises of silver, claims on silver, legal agreements that one party will deliver silver to another at a specified future price. Here's the wild part. The paper silver market is orders of magnitude larger than the physical silver market. We're talking about a market where more silver is traded on paper in a single day than is mined in an entire year across the entire planet. Think about that for a moment. More silver changes hands on screens and in computer systems than physically exists in the form of ready, deliverable metal. This isn't a conspiracy theory. This is just how modern commodity markets work. Now, why does this matter for understanding the crash? Because when you have a market dominated by paper contracts, you create a system that is exquisitely sensitive to leverage. Traders don't put up the full value of their silver position. They put up a fraction, called margin, and borrow the rest. This leverage amplifies gains on the way up, which is what draws in the speculators and the hedge funds and the momentum chasers when silver is ripping higher. But that same leverage becomes a weapon on the way down. And the rules governing that leverage, they can change. The institution that controls the primary futures exchange for silver in North America has the power to increase margin requirements at any time. They can decide overnight, if they want to, that traders now have to put up more capital to hold their positions. And when they do that, it sets off a chain reaction. Imagine you're a hedge fund and you're holding a large leveraged silver position. You bought it with a certain amount of money down. Now the exchange tells you that the margin requirement just jumped. You have two choices. Either you put up more cash immediately or you close your position. And if dozens, hundreds, thousands of leveraged traders are all forced to make that same decision at the same time, they all start selling simultaneously. It doesn't matter what silver's fundamental value is. It doesn't matter that mines are running supply deficits. It doesn't matter that industrial demand is at historic highs. When the margin call hits, you sell because you have to, not because you want to. This is the mechanism. This is what happens when silver drops sharply in a very short window of time. It's a paper avalanche, a cascade of forced liquidations. It is not a verdict on silver's real-world value. It's a verdict on the leveraged structure of the paper market. And here's what makes it even more fascinating from a historical perspective. This exact playbook has been run before, more than once. And if you study those prior episodes, the pattern that emerges afterward is striking. Let me take you back to the 1970s, because that decade is the template for everything we're experiencing now. Picture America in the early 70s. Nixon has just severed the dollar's last link to gold. Inflation is raging. Oil prices are exploding. The purchasing power of the American dollar is eroding year after year, and ordinary people are watching their savings lose value in real time. Sound familiar? Silver begins climbing. At the start of that decade, silver was barely over $1 an ounce. By the mid 70s, it had run up dramatically, surging by over 100% in a matter of months during the first big rally. Investors piled in. The excitement was palpable. And then it crashed hard. Over a span of roughly 2 years, silver gave back the majority of those gains. It fell by nearly half from its peak. The people who had bought near the top looked at their positions and felt sick. Many of them concluded that silver had been a speculative bubble and they'd been foolish to participate. They sold. They walked away. They never came back. And then something extraordinary happened. From the lows of that mid-70s correction, silver began to climb again. And this time, it didn't stop at the old high. It didn't even pause there. It blew through it. By early 1980, silver had reached $50 an ounce. From the lows of that correction that seemed so devastating at the time, silver had gone up roughly 15 times over. The people who sold near the bottom missed one of the most spectacular wealth-building events in the modern history of precious metals. The correction looked like the end. It was actually the setup. Now let me tell you about a different kind of story from that same era, because it reveals something else about how this market works and who the real players are. In the late 1970s, two brothers from Texas named Nelson and Herbert Hunt began accumulating silver at a scale that was unprecedented in modern financial history. The Hunt brothers weren't just buying futures contracts. They were taking delivery of physical silver, actual bars, minted and refined, and having it shipped to warehouses and even to Switzerland. At the peak of their accumulation, the Hunt family and their associates were believed to control somewhere around 100 million troy ounces of silver. Their holdings represented a meaningful fraction of the world's entire above-ground supply. What drove them to do this? They understood something that most people around them didn't. They could see that the dollar was being debased. They could see that inflation was structural, not temporary. They understood that real assets, physical, tangible assets that couldn't be printed, would hold their value when paper currencies didn't. So they acted on that conviction in the most aggressive way imaginable. The price of silver during this period went parabolic, precisely because the Hunt brothers' buying had effectively cornered a significant portion of the physical market. Supply was being taken off the table at a scale the market had never seen. And then the same people who had changed the rules in the paper market did something dramatic. The exchange raised margin requirements on silver futures dramatically and repeatedly, effectively making it impossible for the Hunts to maintain their leveraged positions at scale. Simultaneously, the exchange changed the rules to limit speculative buying while allowing selling to continue. The Hunts were forced to liquidate. The price collapsed from near $50 to under $11 in a matter of weeks. The Hunts were ultimately financially ruined. But here's the detail that gets buried in every textbook version of this story. The physical silver they had accumulated, it was real. It didn't disappear. The bars were still in the vaults. The metal still existed. What collapsed was the leveraged paper structure built on top of the physical reality. When the paper leverage was destroyed, the price followed. But the underlying asset, the actual silver, was still there. This is the eternal lesson of the silver market. Paper and physical are two different animals. One is a claim, the other is a reality. And when the claims start getting liquidated, you shouldn't confuse the carnage in the paper market with the story of the physical metal underneath. Now let's jump forward to the crash of 2008, because there's a chapter in that story that most people completely skip over. When the global financial system began to unravel in late 2008, silver didn't just fall. It got absolutely crushed. In a matter of months, it lost more than half its value. On the surface, this looked like a repudiation of the precious metals thesis. If silver was supposed to be a safe haven, why was it getting obliterated alongside stocks and real estate? The answer, again, was leverage and liquidity. When institutions started blowing up, they needed cash. They didn't care what they sold. Everything went. Stocks, bonds, commodities, gold, silver. The selling wasn't about fundamentals. It was about survival. Margin calls across the entire financial system forced liquidations in every asset class simultaneously. And what happened next? Silver began to recover in early 2009. And then it kept going. From the lows of that crash, silver more than quadrupled over the following 2 years. The people who bought during the panic, the ones who understood that forced liquidation selling doesn't change underlying fundamentals, made extraordinary returns. Then came 2011. And this is the one example I want to spend a little extra time on because it's the one that matters most for understanding what's happening today. In the spring of 2011, silver had run from about $18 to nearly $50 in roughly 8 months. It was an extraordinary, almost vertical move. The silver community was electric with excitement. Some analysts were calling for $100. Others were talking about silver finally breaking free from its historical chains. And then the exchange raised margin requirements 5 times in 2 weeks. 5 times. The cumulative increase was over 80%. Forced liquidations were catastrophic. Silver fell more than 30% in a single month. At first glance, this looks identical to the pattern we've been discussing. Margin calls, paper selling, forced liquidations, same mechanism. But here is the crucial difference between 2011 and the crash we're looking at now. In 2011, the macro environment was shifting. The Federal Reserve's extraordinary monetary stimulus was winding down. Real interest rates after adjusting for inflation, were beginning to rise. A stronger dollar was emerging. The monetary forces that had powered silver's run weren't just pausing, they were reversing. Silver spent the next 4 years grinding lower, ultimately bottoming near $14 an ounce. The crash in 2011 was real because the conditions that created the bull market reversed. That is not what is happening today. Today, supply deficits in physical silver are not just intact, they are growing. For multiple consecutive years, the world has consumed more silver than it has produced. Mining output is not keeping pace with demand, and the demand side of the equation keeps expanding from directions that didn't even exist a decade ago. Think about solar energy. Modern photovoltaic cells require silver, a substantial amount of it, because of silver's unrivaled electrical conductivity. The global push to build out solar capacity is not slowing down, it's accelerating. Every gigawatt of new solar capacity that comes online requires silver to build. And as countries around the world race to meet their energy transition commitments, the demand for silver from the solar sector alone is projected to consume an ever larger share of annual mine supply. Then there's the electric vehicle revolution. The wiring, the sensors, the battery management systems in modern electric vehicles all rely on silver. As the global vehicle fleet transitions away from internal combustion, the industrial demand for silver follows. And this isn't speculative future demand. It's demand that is already in the market right now, growing year after year. Add artificial intelligence hardware. The server infrastructure being built out to power the AI revolution requires enormous amounts of silver-bearing components. The data centers going up around the world are consuming silver at a scale that wasn't in any demand forecast from 5 years ago. The AI build-out has added a new structural demand driver that is genuinely new to this cycle. And then there's the defense sector. Military electronics, communication systems, precision guidance technology, all of it uses silver. As geopolitical tensions increase and defense spending ramps up across the Western world and beyond, silver consumption in this sector is growing quietly in the background. Now, here's the thing that should make you sit up a little straighter. All of this industrial demand is inelastic in a meaningful way. Solar panel manufacturers don't have a substitute for silver's conductivity. Electric vehicle makers don't have an alternative that performs the same way. Semiconductor manufacturers can't swap out silver for something cheaper without degrading performance. The demand is real, and it's growing, and it's competing for a supply that is structurally constrained. Quick aside here, if you're watching this and you're sitting on significant savings in retirement accounts, I put together a free guide that walks through how gold IRAs actually work, how you can hold physical precious metals inside a tax-advantaged retirement structure, how people are doing this to protect their hard-earned wealth from exactly the kind of monetary and financial instability we're discussing right now. It's in the description below. Worth 5 minutes of your time if this is relevant to your situation. Now, back to the deeper story. There's a layer to this that most financial commentary completely misses, and it has to do with the geopolitical architecture that underpins the silver market in ways most retail investors never think about. We are living through a period of significant de-dollarization. Countries that used to conduct their international trade exclusively in dollars are increasingly making arrangements to transact in other currencies. The BRICS alliance has been explicit about its desire to reduce dependence on the US dollar in global trade and finance. China has been steadily building its gold and precious metals reserves while simultaneously reducing its holdings of U.S. Treasury securities. Russia, despite its isolation from Western financial systems, has continued accumulating gold at a pace that suggests it views hard assets as the foundation of its monetary architecture. This matters for silver because silver is the poor man's gold. When geopolitical uncertainty rises, when confidence in paper currencies erodes, when institutions and governments seek to hold assets that cannot be defaulted on or inflated away, they reach for hard money. And silver, with its much lower price point relative to gold, is accessible to a far broader universe of buyers. The gold to silver ratio is a number that sophisticated precious metals investors track obsessively because it reveals something important about relative value. Historically, this ratio has ranged dramatically. In ancient times, it was often around 15 to 1, reflecting the natural occurrence ratio of the two metals in the Earth's crust. In modern markets, it has at various times reached extremes of over 100. When the ratio is high, it means silver is cheap relative to gold on historical terms. When it compresses back toward historical norms, silver tends to move faster and further than gold. The ratio right now tells a story of silver that hasn't yet been fully valued by the market in the context of everything that's driving this bull cycle in precious metals broadly. And then there's the Federal Reserve. Here is perhaps the most critical structural factor that separates this moment from 2011. The Fed is caught in a trap. On one side, inflation remains a persistent problem. On the other side, the US government is carrying a debt burden of extraordinary magnitude, a burden that is sensitive to interest rates in ways that previous debt levels never were. Every time the Fed raises rates aggressively, it increases the cost of servicing that national debt. The math becomes increasingly uncomfortable at higher rate levels. What this means in practice is that the Fed does not have the freedom to raise real interest rates to the levels that Paul Volcker used in 1980 to break the precious metals bull market of that era. Volcker took rates to nearly 20% because he was willing to cause a severe recession to kill inflation. The political and fiscal environment today makes that kind of aggressive rate action extraordinarily unlikely. The debt is too large. The political pain is too immediate. And here's why that matters. The single thing that has historically ended precious metals bull markets, genuine positive real interest rates sustained over time, is the one thing that appears structurally difficult to achieve in the current environment. Silver's monetary tailwinds are not reversing. They're intact. So let me bring this all together now, because I want you to understand what I believe you're actually looking at when you look at the silver chart. What you're seeing is not a reflection of diminished fundamental demand for physical silver. What you're seeing is the systematic demolition of a leveraged paper structure that had built up on top of silver's price. You're watching forced liquidation, the unwinding of speculative positions held by traders who never intended to take delivery of a single ounce of physical metal. They were playing a paper game. The rules of the paper game changed, they got washed out. This is not the same as the economy deciding silver is worthless. It's not the market voting against silver's fundamental story. It's financial plumbing. It's the difference between the price of a stock during a panic sell-off and the underlying business's actual earnings power. The business didn't change. The panicking shareholders changed. Now, none of this means prices can't go lower in the near term. Markets can be irrational longer than most people expect. Paper selling can create a vacuum that takes time for physical buying to fill. The leverage unwind can overshoot in both directions. Anyone who tells you they know precisely where silver will bottom in a correction like this is lying to you. Anyone who claims to have perfect timing in a market this volatile is selling something. What history tells us with remarkable consistency is that the investors who survive these corrections and come out ahead are the ones who keep asking the right question. Not why is silver falling, but has anything fundamental changed that should cause me to reconsider my long-term thesis? In the 1970s, the investors who asked that question after the mid-decade crash looked at the fundamentals and said, no, nothing has changed, went on to participate in one of the most explosive precious metals rallies in modern history. The investors who panicked, who decided the correction meant the bull market was over, locked in losses and stood on the sideline watching prices climb without them. In 2008, when silver got absolutely destroyed in the liquidity panic, the investors who understood that forced selling isn't the same as a fundamental change in value, who looked at a crushed price and saw an opportunity, more than quadrupled their money over the next several years. The pattern is not perfect. The 2011 peak was followed by a genuine multi-year bear market, and that's the cautionary tale in this entire story. The mechanism was similar. The outcome was different because in 2011, the underlying conditions reversed. Today, by most serious analysts' assessment, they haven't. The supply deficit is still there. In fact, it has been deepening. Industrial demand is still growing. The monetary environment, the inflationary pressures, the geopolitical instability, the erosion of confidence in paper currencies is still present, and by many measures, more intense than it was when this bull cycle began. And here's the final layer of this story that I want to leave you with, because I think it's the most important thing to understand. Physical silver is a different animal from paper silver. When you own a futures contract, you own a claim. When you own a physical silver coin or bar, you own a reality. You own something that has held monetary value across 5,000 years of human civilization, something that no government can print, something that no institution can default on, something that doesn't have a counterparty risk attached to it. The paper market can crash. The paper claims can be margin called into oblivion. The leveraged hedge funds can be forced to sell simultaneously, driving the quoted price down to levels that seem to defy logic. But the physical metal sitting in a vault somewhere, it's still there. It didn't become less real. It didn't become less scarce. It didn't lose its industrial utility. It didn't lose its 5,000-year history as a store of value. The brutal drop you're watching is a paper event. The physical story underneath it is something else entirely. And the investors who can hold that distinction clearly in their minds, who can watch the paper panic without confusing it for a statement about the underlying reality, those are the investors who have historically been in a position to make extraordinary decisions when the rest of the market is paralyzed by fear. Now, I've been talking about this for a while, and I want to end with something practical, because understanding the market is only half the equation. The other half is positioning yourself so that the volatility works for you rather than against you. If you're a retiree or approaching retirement and you've worked your entire life to build a nest egg, what's happening in the broader financial landscape right now, the inflation, the currency instability, the geopolitical fragmentation, the debt crisis that every serious economist is warning about, all of this is not hypothetical. It's real, and it poses real risks to retirement savings held in conventional paper assets. The good news is that there are tools available to protect and preserve that wealth. Physical precious metals inside tax-advantaged retirement accounts have become increasingly popular with Americans who understand what's coming and want to position ahead of it. It's not about gambling or speculation. It's about having a portion of your wealth in assets that have survived every financial crisis in history, assets that can't be printed, assets that have outlasted every empire that ever tried to replace them with paper promises. Here's what I want to leave you with. I've put together a completely free guide that walks through exactly how this works, how to move a portion of existing retirement savings into physical precious metals through a structure that preserves your tax advantages and puts real, tangible wealth in your corner. Thousands of American retirees have already used these strategies to protect what they've built. The guide is in the description below, and for those of you who watch all the way to the end, which you just did, if you reach out and mention that you watched this video, you qualify for a complimentary one-on-one educational consultation. No pressure, no obligation. Just a real conversation with someone who can walk you through the options. It's exclusively available to American retirees who have at least $100,000 in any retirement account. Because here's the truth. The brutal drop in silver prices isn't the story. The story is what's underneath it. The story is what the paper market crash reveals about the physical market reality. The story is that the exact same mechanism that just wiped out the leveraged speculators is the same mechanism that cleared the way for some of the most significant rallies in silver's modern history. History doesn't repeat with perfect precision, but it rhymes loudly enough that the people who are paying attention and who understand the mechanics, rather than just reacting to the headlines, tend to end up on the right side of these moments when the smoke finally clears. The description has the free guide. Take a look, and I'll see you in the next one.